Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus hosting your host with Brian London. So pleased to be with you. Thank you for subscribing, all our new listeners. It's greatly appreciated. We have a repeat guest, one of our favorites, Peter Boockvar. He is the Chief Investment Officer with the Bleakley Advisory Group. He is a CNBC contributor, and Brian describes him as the, how can I put it, the contrarian there. He's also editor of the book report. Peter, welcome back to the show.
Great to be here. I appreciate having me on.
And Peter, I've been seeing you on social media, making lots of appearances, and you're one of the early people, I guess, calling the presence or the imminence of inflation. Is it just coming or has it arrived?
Well, I've always broken down inflation into, we have monetary inflation. We've had monetary inflation since 2007.
Sure.
It's a question of where that monetary inflation ends up showing up. So consider that like Tinder, and then it depends on where it shows up. Obviously, it showed up in asset prices, not in consumer prices. And with consumer prices, I break it out between goods prices and services. Services have seen pretty much a persistent rise of 2.5–3% year-over-year increase for at least the past decade. A lot of it is higher rental costs, medical costs, insurance, tuition, a variety of things. I mean, the viewers should raise their hand if they paid, I'm talking about last year, less for a baseball game ticket or a football ticket than they did 10 years prior, or for a concert. So services prices generally have risen. What's offset that is this price compression on goods. And some of that is technology efficiency. Some of it's actual technology products where we're getting more for less. But sometimes it's also how they measure it. The price of a new car is today much higher than it was 10 years ago, but because of how the government hedonically adjusts it for the improvements on that car, they tell you that prices actually went down. So just statistically, it's been goods that prices that have remained subdued, inflation in the services side that has remained elevated for a net result of, call it 1.5, 2 that we've seen. So when I think about where inflation goes in the next couple of years, because services inflation remains pretty persistent, I mean, medical care costs are going to be pretty sticky. You look to see on the goods side of where is there potential for goods prices to go up. And even part of that being parts of the services side too. And I think with the pandemic and COVID, we've seen in supply chains around the world turn upside down. We've seen, you look at the truck side, I'm going to give different examples and how I sort of get to my thesis. We've had, over the past year, we've had many companies in the trucking industry go out of business. It's been a lot of bankruptcy. So you've had this capacity that has come out of the trucking industry. So if you're a supermarket, it was hard enough in April and May to actually get stuff on your shelves physically from the companies that were making that product, but it was even more difficult to actually get a truck that was going to deliver it from point A to point B. Then you take recently news from FedEx and UPS. So passenger airlines, yeah, they take up people, but there was a portion of that industry that also took cargo. Well, because of what's happened to the airline industry, a lot of capacity has been taken offline. So a lot of that cargo that was taken by them needs to be taken by somebody else. So FedEx, UPS are getting overwhelmed now with demand because everyone's now trying to utilize them and the Postal Service for deliveries. So UPS and FedEx in response are saying, okay, going into the holiday season, we're going to be tacking on a surcharge of $1 and up to $4 for every single package that we move. So every single thing that gets brought to you, that price will probably get passed on to the consumer. And take airlines, for example. Let's just say that we get a vaccine and all of a sudden people want to get back on planes again. Well, airlines are not going to be able to snap a finger and hire back thousands of pilots and thousands of flight attendants and bring all those planes back just like that back onto the tarmac. It's going to take time. But in the meantime, you're going to have demand that's going to overwhelm supply, and you're going to see a rise in prices. So I think that, and then also on the commodity space, we've seen a lack of supply, even before COVID. Take copper, for example. There were supply issues around the world, and now you have pretty decent demand for copper, and the supply side's just not keeping up. We've seen a rise in lumber prices that have literally been off the charts. Less people are buying new cars than buying used cars. Used car prices have literally spiked. So I think that you combine that with a level of demand that has been pretty strong. And I say strong, relatively speaking, but that's because the government transfer payments to consumers have actually exceeded the lost wages and income that we've seen in this recession. So we've kept the level of demand very elevated. We've really cracked the supply side, that especially when you get a vaccine and the demand side is going to potentially increase even more, that supply side just not going to be able to catch up in the snap of the finger. It could take a few years for that to happen. So the supply driven cost push inflation, I think, is already beginning to show up. We saw that in CPI and PPI last week, and it will continue over the rest of this year and into next year. Now, the counter argument is that, well, the recent inflation reads we're seeing is sort of just a give back, and that we had a sharp decline because demand collapsed, and now we're just getting back what was lost. I think that this is going to be more persistent. I think we have to start getting used to seeing 0.3, 0.4, maybe 0.5 month-over-month increases in CPI, both headline obviously more influenced by energy, but certainly at the core level. And I think that's going to take people by surprise. And we're now keep in mind that for decades, particularly over the last 10 years, we've just been trained on low inflation, ever falling interest rates at zero. Rates will never ever go up. Well, I think that if I'm right, we have to start altering sort of our mindset, and that rates maybe in the short term, because the Fed's pinning them to zero, could stay at zero, but that doesn't mean longer term interest rates are just going to stay as low as they are. And I've argued that we have to start looking at the 30-year bond as sort of an indicator of price discovery and market messaging, because the 10-year is sort of losing that flavor because of the Fed's talk about keeping rates low forever, even yield curve control, notwithstanding what they said in the minutes, and that part of the curve still being somewhat bullied by Fed commentary, and certainly where bonds are in Japan and Europe. That is sort of a dead weight on rates here.
One interesting point I heard you make earlier is that if the Federal Reserve is willing to accept higher inflation, that will have repercussions for the bond market, there'll be some tension there. What problem are you referring to exactly?
Well, the idiocy of central banks wanting higher inflation, they lower interest rates in their eyes to stimulate economic activity. They want you to borrow money today instead of saving up for something later. So they make a deal. They say, you know what, I'll lower interest rates today. So instead of saving up for that down payment over the next year, well, we'll let you borrow even cheaply today. So just do it today, and do that with a car as well. Well, if they want higher inflation, well, then that means that rates then have to adjust higher, which would offset the purpose of what they're trying to accomplish on lower interest rates. And we have a very consumer-dependent economy. So, and you guys have heard me say this, so that if you just replace the word inflation with cost of living, well, how does a higher cost of living in a consumer-dependent economy equal faster growth? Like, central banks have this mistaken belief that quicker inflation is the same thing as faster growth. I think what the real reason is why central bankers want to have 2% inflation is not because that models out to a good economy. What it models out for them is they assume that if inflation's 2, the Fed funds rate should be at that level or higher, that if you got into an economic downturn, they would have Fed fund rates to cut. So they've really damaged that initial thesis to now think that higher inflation is sort of the means to an end, rather than inflation just being a symptom of supply and demand and following and being the end. So they've sort of put the cart before the horse and saying inflation then leads to growth. It should really be growth. And then, well, we've had periods in this country where low prices are a good thing, and low prices have led to stronger growth. I mean, we're all talking on a computer. So you take in 1981, the IBM PC. Well, if that price of that computer went up 2% per year, which is what the Fed's inflation target is, that computer would cost $6,000 today. Would that be a good thing? No, we've progressed as a society because we have more computing power at a lower price.
Peter, great points. And just to touch on one of the ones you just made, that central banks want inflation and they think that they can raise rates to keep up with it. But their primary method or tool in battling higher inflation is higher interest rates. And in fact, positive real rates to get ahead of rate of inflation. But with debts the way they are now, because these persistent periods over a decade of essentially zero interest rate policy or ultra low interest rates, that's encouraged so much debt creation, not to mention the stimulus spending and everything else. And the federal debt in the US, which was already out of control, is now just, much more out of control. So they really can't afford to have positive real rates anymore, in my view, because they can't afford to service that debt. And yet that's the only way they can fight inflation. So if inflation gets just a bit out of hand, if the genie gets out of the bottle and only has 1 foot left in the bottle, then they're going to try and stuff it back in. I mean, the record shows that the only way to do that is to really hike rates like Volcker did. And that's just impossible in this day and age, I think.
You're absolutely right. I refer to higher inflation as kryptonite to a central bank because it really completely handcuffs them and renders them somewhat worthless, but not in a good way. And it gets to the point of central banks are so good at going all in on the easing side that they never think about what are the repercussions of trying to rein this in if they actually get the growth and inflation that they search for. So imagine what happens to the European bond market if the ECB just decides to go from negative interest rates back to zero, let alone a positive nominal rate, just to get back to zero. You will have carnage like you've never seen in the financial markets. When you have $15 trillion of negative yielding securities, just imagine on a mark-to-market basis what happens if those rates if it just goes back to zero. You're going to have a lot of basis points times $15 trillion that are going to be lost. So that's why I get to the point of the central banks should not really be wanting the higher inflation that they're rooting for, because how are they going to raise interest rates without blowing up the world's bond market, which is the greatest financial bubble in the history of the world, and damaging this over-indebted world that they've also created?
And what about the other side of the coin? What if they can't control interest rates? What if the market says that they're really ignoring, they're becoming oblivious to higher inflation, they're not, and the market demands higher interest rates, and the central banks and the Fed in particular cannot control interest rates, cannot keep them at these low levels or at zero real levels. Is there still enough of a private bond market out there where the Fed could lose control of interest rates?
Well, I think in the US, yes. Obviously in Japan, where the Bank of Japan owns almost half the JGB market, where they've been able to completely put their foot on the neck of interest rates. In the US, it certainly will be harder, because you take just the US budget deficit right now being 14% of GDP. I mean, the Treasury issuance now is going to start to offset a lot of the Fed purchases. And that if we got to higher inflation, how would the Fed be able to substantiate doing more QE if they're seeing higher inflation? Because then more QE can then feed more higher inflation. So their potential cure could actually exaggerate the disease of higher inflation, which higher rates would try to be responding to. Then you wonder, okay, well, they do what they did after World War II and try to pin the 10-year yield at some rate. Well, maybe they can do that, but that gets to be really difficult to do when you have an extraordinary amount of Treasury supply and inflation too. And it's one of the things in the Fed minutes is they did talk about the logistical challenges of implementing yield curve control. Because there's one thing to say, okay, I want the 5-year to be here, the 10-year to be there. but to actually implement that policy, whether it's a verbal or it's physical through their purchases, it's not an easy thing to do. And as much as I criticize the Fed, you want to hope that there is some like heartbeat of the desire for price discovery in some way that still exists there. You hope that they don't want to just destroy it. And that will be the real test of the Fed is whether there's any Paul Volcker legacy left in that institution if we were to see higher inflation at some point later this part of this year or into next year.
So what happens if the Fed does lose control? If the market says we need higher rates, we need a higher rate of return to justify the rate of inflation or just the risk that we see in the future? What does the Fed do in that situation?
Well, it's the $64,000 question, and it's not a model that I think that they are fully thinking about. I think in their eyes, yeah, we'll just raise interest rates and it'll be no big deal. But we know that this time around is going to be easier said than done. I mean, look how difficult and impactful it was for them to just shrink their balance sheet from 4.5 to 3.5 trillion, or to go from 0 rates after 7 years to 2.25%. I mean,
right.
that took years for them to implement. They went 2 years with raising interest rates a total of 50 basis points over 2 years. So I think it's going to be an extraordinary test. Now, we know if I was in that seat, you can't just spike interest rates on the short end and the Fed funds rate because of what that potentially can do. You basically have to jawbone the market to say, we're going to start raising interest rates. We need to get back in control of inflation, but we're going to give you notice. So we'll gradually raise interest rates, because the problem in that scenario is an uncontrolled rise in rates. Something that is more orderly, that can be spread out over time, it's something that we can all adjust to. It's sort of the disorderly market moves that create more chaos than not. So if it becomes disorderly, the Fed will try to gain back control in some way, but it's a really dangerous game that they'll be playing, because you can be sure that any accommodation that they'd want to remove will be a lot slower than that rise in interest rates. So that's the scenario where you get another leg lower in real interest rates. Is that because, I'm reading some articles now that like, how can real rates go any lower? And it's just a very easy answer. Inflation just needs to pick up faster than the Fed's going to raise interest rates. And
right.
That's how you're going to get lower real rates and another leg down from here. And that's how you get the next leg up in precious metals and commodity prices and so on.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hi, this is Brian London with our CEO interview, which we do every week with one of the CEOs of a Discovery Group company. The Discovery Group being an affiliation of junior mining companies that is the sponsor of the Gold Newsletter podcast. And today we have the pleasure to have Alex Heath with us of 𝗂𝗂𝗍𝗆. The symbol is KTO on the Venture Exchange. And Alex, exciting things going on with 𝗂𝗂𝗍𝗆. We've talked about it on this podcast before, that the Mojave property is a premier gold property. A number of top experts and explorationists in the industry said it's the single best target they've ever seen. And it's in 𝗂𝗂𝗍𝗆, and it has been lying fallow for years because of disputes about land use, et cetera. But now it's full speed ahead, drilling imminent. Can you talk to us a little bit about the property and the number of targets that you have, and where you are is in relation to financing a drill program, et cetera?
Absolutely. So I'll start with the targets. So we are permitted for a phase 1 helicopter assisted drill program. That'll be a program that's targeting 4 different areas, the Dragonfly and the Newmont, and there's going to be 2 drill sites on each one. Each site will have 4 holes drilled from each one of those. In terms of the financing for that program, we just announced on Monday this week that the proceeds from the acceleration of our warrants had come in, and we've raised just over $2.5 million from that. So we are well financed to pay for that first phase of drilling, and that should begin very imminently now.
Yeah, and I think I should mention that this property has been drilled before, but that was left kind of unfollowed up on for a number of reasons by other previous operators, and fairly well explored in surface work, et cetera. But those previous drill results and the trenching results are really some of the best I've ever seen. Just some remarkable grades over extensive intersections. And you're following up now, or will be following up on those previous drill results. So the odds, at least in my view, of success and delivering really good drill results to a market that's very receptive for them are really very high.
Yeah, absolutely. The last time it was drilled was in the mid-1990s. And as you said, the project itself has been caught up in various issues with land use. And now that we have full and clear access to that property, we will be following up on those very exciting prospects. As you said, surface expression is very good. We see gold on surface. It's an oxide mineralization. And we're just going to follow up on the most prospective targets first.
Yeah, and you recently made some news about a new anomaly that was located. And as I was reading that, I noticed some similarities, particularly with the use of the worldview spectral imaging technology with some other Discovery Group companies, particularly Valor Resources used that in to delineate some targets. They were looking at some coincident targets with the worldview spectral imagery and geophysics. And those are starting to pay off now as we see the first drill results come from that company. And then I noticed that K2 is using the same technology. Can you talk a little bit about that and how that works on this really very large land position that you have?
Absolutely. No, Worldview 3 is a multispectral satellite imaging technology. It's the highest resolution satellite imaging that you can buy commercially. So anything higher than that, you're getting into espionage and government type satellites. It's really good for our type of project because we do have a superficial gold expression to the asset. It's a little bit different from Valor. People might know Valor. You can see it a lot better. You can see there's some dark staining. With Mojave, you don't see it as well, so you do need to use that multispectral analysis. And what we have, and I can walk the camera over a little closer, we do have the Worldview 3 alteration map here, and hopefully that comes through. But you can see on the eastern margin of the property, the Dragonfly and the Newmont have been drilled fairly extensively, and we know that there's gold on surface. And what we're seeing is that it's corroborated by that Worldview 3 technology. We're seeing these dark red and orange staining here is the multispectral hotspots.
And that's
we also see
mineralization right there.
Yeah, so we know from surface trenching and from drilling that there's gold associated with what we're seeing in the Worldview 3. However, we also see other targets that have not been extensively explored or drilled at all. So we're very encouraged by seeing areas that no one has really walked. This is a very large property. It's in near the Mojave Desert, so we're talking 100+ degrees Fahrenheit. So there hasn't been a lot of substantial exploration done on certain areas.
Yeah, not that easy to just walk out and walk the ground. So you've got enough money now for this first phase drill program, which should be beginning imminently, I would think. And so results imminent as well. And that's going to be on these known target areas. And then further along the line, I guess you're hoping to finance the company at higher share prices to explore all of those targets that you've now just shown us.
Yeah, absolutely. Yeah, phase 1 results will help guide us for phase 2, which will look to expand beyond those 4 areas. Newmont and Dragonfly are fairly far apart, say 2-3 kilometers apart. So we'll be looking to infill between the two so that, the goal of this drilling program is to come up with a resource, but we're going to need to have more closely spaced drilling to get to that.
Well, the good news there is that you're very confident in that you'll get that resource, again, because such previous work with such outstanding results. Well, Alex, I'm very happy to say that we just added K2 to our recommended list in Gold Newsletter recently, because these levels with that kind of a target are really irresistible. I think that the company is one of those few that have been kind of not so much left behind, but are still gems sitting there ready to be picked up in this market that's been moving so quickly. In particular, with gold looking like it's going into a bit of a sideways consolidation panel for the next month or two, a lot of the companies have come back in price, and the price levels for K2 right now, I think, are just really perfect, just a tremendous buying opportunity now that you've come back a bit from those highs when you were just announcing drilling, the approval of a drilling program.
Yeah, absolutely. Well, thank you very much for that.
Thank you, Alex. And I know we'll be keeping our readers in Gold Newsletter in the loop, and we'll have more interviews coming down the road. So good luck with the drilling. Looking forward to seeing the results.
Thanks. Take care.
The other constricting factor, I think, is that post-2008, and even before that, they wanted to create this wealth effect. And they wanted to pump up financial assets. Originally, it was a real estate market that led to 2008. And then it was all financial assets, real estate, equities, bonds, everything. And they wanted to create this wealth effect so people felt richer and then they would spend more, et cetera, et cetera. But they've created this monster now that they have to feed. And this monster is not, doesn't just want easy money anymore. They want ever easier money. And so they have to keep coming up with new ways to find new levels of accommodation to keep this house of cards they built standing. It doesn't seem to me that they can afford to allow the equity markets, for example, to totally crash from these levels. And that if periodically, and it would have happened, I think, at some point, regardless of COVID, the stock market was going to pitch a hissy fit and tell the Fed, we need some more accommodation. I mean, that's what happened when they tried to raise rates. They basically dictated orders to the Fed that, no, we can't take this anymore. You need to start lowering rates. And they essentially started quantitative easing months before. I mean, they started it last August, about a year ago.
Right, in order to control the repo markets.
Yeah. So there's a lot going on there. It seems to me they're truly painted into a corner and there's no way out.
That's 100% correct. There is no way out. And if you believe that everything will end up being okay, then you believe in free lunches. And there's just not going to be a free lunch. It's just been trying to figure out when it will matter has been the most important factor here. And that's why I get back to in a way I'm wrong on inflation, because if I'm right, that's when all this stuff that they've done begins to matter. And, we've seen that Fed policy or central bank policy in other parts of the world doesn't always equate to higher stock prices. So for investors in the US to just rely on what the Fed is doing as a reason to rationalize certain level of P ratios, well, all you have to do is look at Japan. Low rates have not inflated their stock market. You look at Europe, the Italian stock market is still down 50% from where it was in 2007. The Greek stock market is still down more than 85% from where it was in 2007. So it doesn't always equate. And even the Fed's balance sheet has stopped growing over the last couple of months.
Yeah, what's behind that? Was that simply repos and swap lines?
Repos and swap lines, right. So it will eventually start to increase again as the Treasury purchases and MBS purchases offset that. I mean, the Fed's still buying on average about $80 billion of Treasuries a month, so it's still an extraordinary level. But you wonder whether they're going to continue to substantiate those purchases if we do get more months of hotter CPI, because then the question is going to be asked to them, well, how do you respond to that? And that'll be something that'll be Jay Powell's worst nightmare if that were to happen.
Yeah, you have to really feel sorry for the guy. I mean, it's really amazing to be in that position at this point in time.
Right, but definitely a position that he put himself in, and so all these central bankers, they all drink the same Kool-Aid of well, if low rates are good, high rates are bad. Low rates make you borrow and spend. That's good. High rates is a crimp on the economy. Well, if low rates are good, even lower rates are even better. And if even low rates are better, then let's get them even lower. And it's just this very simplistic way of thinking that ends up, I've argued, to do more damage. Well, we know all the debt that's accumulated through this, but I've argued that this whole concept of forward guidance and just having rates low forever is actually doesn't stop stimulating growth, because the word stimulant is to get you to do something now instead of later. It's to try to stimulate you to behave now. And if you think rates are just going to stay low for a long period of time, you just wait, because there's no rush to do anything.
Yeah.
So it loses its stimulus nature, and that's the point that we've reached. So when I hear a central banker and the Fed members talk about, oh, forward guidance is their next thing, they still believe and they still model out that as being an economic stimulant, and I call it that's actually an economic depressant.
Yeah, and the markets then bet and expect on more stimulus. And the addict, the now trite comparison analogy, the addict needs more of the same drug to get the same effect. So they're expecting not easy money again, but ever easier money. Now, just to get to more closer to home for us, you were one of the first really mainstream analysts and economists to call for higher gold and silver prices for a lot of these same reasons. And one of the reasons that we've been putting forth in Gold Newsletter for some time is simply the debt, that this is nothing new. It's not just something that's new today, but throughout history, civilizations have created debts that they couldn't manage, and they've always debased the currency. It's the same prescription every time. The difference now being that it's an interconnected global economy, and every economy out there has the same problem with outsized debts, unmanageable debts. So they all have to devalue their currencies. And people talk about a strong or a weak dollar, but it's just who's leading in the race down the hill, which currency is currently in the lead. And they're all devaluing against something. Lately, that's been gold and silver, quite dramatically. What are your views? I know you've been very bullish on gold and silver very generally, but after this tremendous run we've had, do you see that we're going to continue, or we're going to have a few months of sideways trading at these levels, or do you even worry about those kinds of trends and focus more on the long term?
No, I after quite a run, as anybody that's been in markets for a long time, you want to see consolidation, you want to see a rest, you want to see backing and filling, you want to see something sort of take a break and recharge their batteries for that next move. I mean, the healthier bull markets are more of the stair step. They're not the straight lines, because the straight lines, just like any sprint, you run out of gas. You want to see a bull market that just is very steady and methodical. And if you do have a spurt, it then takes a breather to catch its breath, regain its energy for the next move higher. And I think that that's what gold and silver right now are in the midst of, is sort of a recharge, a regaining of energy, catching your breath after a big move. Now, that's obviously technical speak. Now, whether that lasts a week or a month or 2 months, we'll have to see. But I think that investors that are in the asset class have to continue to go back to what's the fundamental backdrop, and has the fundamental backdrop changed to cause this consolidation, or is that fundamental backdrop still very robust and still in play and still something that will take more years to play out? And I believe, and I'm sure you do as well, that this has more time to play out, and that if we're correct, if you break down, and I know you, Brian, you've been very good at this in your newsletters and trying to tell investors that focus on the factors that are most important and long-lasting in impacting the price of gold and silver. Don't get sidetracked by the things that are more fleeting, like geopolitics, for example. You're very good at saying, yeah, the geopolitical event happened. There was an oil field in Saudi Arabia that the Iranians blew up, and gold spiked, but those type of things don't last. At the end of the day, precious metals will go the opposite way of where markets think of the value of fiat currencies and real interest rates. And as long as you believe that real interest rates will continue to trend down because you think that inflation will continue to tick up and central banks are not going to respond in an aggressive way at all for reasons we discussed earlier, and that the dollar still has these major headwinds, particularly a budget deficit that has gotten completely out of control, and anybody can graph since 1980 budget deficit relative to GDP versus one's currency, not just in the US, but anywhere. And you can see that the fundamental drivers for these metals are still very positive. And that silver is still almost 50% below where it was 9 years ago and where it was in 1980 on those parabolic spikes. Gold has essentially done nothing for 9 years, and on an inflation adjusted basis, probably deserves to be 40% higher than it is today. We know markets overshoot, and we know also in fresh bull markets, you usually exceed your prior highs. Well, if that was 2011, you know that we're there in gold, and we've got a long ways to go in silver. So I think that it's healthy as an investor to always take a gut check and say, okay, let me reanalyze my fundamental thesis. If you believe that fundamental thesis is still in place, well, then you have to understand that markets do correct and markets do consolidate. And sometimes you're going to say, wow, I should have sold gold when it hit 2050. I should have sold, and now it's at 1950. And what am I going to do? Well, if you're still confident on that fundamental thesis, understand that it's not healthy to go up in a straight line. It's actually more healthy to go up in a more methodical way, and that you want to shake out the weak hands. You want to shake out the momentum players because the long-term players are still there. And again, like I said, it's good to recapture your breath and get ready for that next move higher.
I know we're running close on time here, but I do want to ask you one question. You know, we sit in this kind of insular world, and you know, as a gold bug and a gold bull, I'm not only dishing out the Kool-Aid, I'm drinking it as well. And we talk about all these long-term, seemingly really secular macro trends that seemingly demand much higher metals prices, and we understand it. But you know, I look at the price patterns for the metals, for gold in particular, and what really strikes me is that it just seems to want to go up and it doesn't want to correct. And when we have these corrections, it's probably the paper gold players in there, you know, driving it down. But it seems to have a limit to the corrections and trades within a range. And that to me just speaks of really a strong undercurrent of buying out there that would seem to indicate really big money institutional investors just shifting allocations and buying programmatically the metals and understanding these big pictures. I know you've got your ear to the ground in that market much better than I do. What do you hear about that? Are we getting big institutions just switching allocations or devoting more allocations to the metals right now?
Well, I think you're right. Corrections don't have to be price only. They don't even have to be price. They can be time.
Yeah.
So you can have just a flat line for a period of time that recharges the batteries and is the form of consolidation. And that's where you get the buyers and the dip. You don't have the higher prices, but you have the weak hands that are quickly met by the new strong hands. Mm-hmm. And that's that's the best type of correction. So there's no question, and the firm on that, where we manage a lot of money, and you have a lot of individuals and high net worth families and so on saying, you know, what's the gold and silver story? Because you know that people don't pay attention to things when they're down and out. They only pay attention after they've had a run. And after they have a run and all of a sudden they're in the newspapers or on TV, that's when you start to get all the questions. So I do think there's certainly a greater level of attention, both on the institutional side and the individual side. Certainly more on the institutional side because, you know, they watch this stuff every day, where the individual is not necessarily as much. But yeah, there's growing interest, but it's growing interest from an extraordinarily low level. So we're still far away from being at the level of interest where it becomes frothy, and overcrowded, and at the point where you have to start saying, okay, maybe it's time for me to exit. I think we're still early on in that game, but there's no question that that interest is growing. And having Warren Buffett, maybe not him individually, maybe it was two of his money managers, buying Barrick Gold was sort of, in some people's eyes, a stamp of approval of this asset class. And that now, after many years, at least in his firm's eyes, that it is an investable asset class that should no longer be ignored.
Yeah, I agree. I think that's the big takeaway from that is they may not be buying gold. Buffett or his lieutenants may not be buying gold, but they recognize the trend and they recognize the kind of earnings that result from that trend. So they're willing to invest in, instead of a compounding growth asset like corporate equities, like Coca-Cola, an extractive industry like Barrick, because you can't argue with the trend that's already there, or the margins of the profitability and the market valuation too. There's a real, it really seems to fit their whole value-oriented modus operandi when you look at the valuations of Barrick and really all of this mining sector.
Right, and the cash flows that they're now delivering.
Yeah,
Buffett can poo-poo gold itself as a pet rock that just sits there and does nothing. But when you buy a company that's producing it at a cost that's well below the spot price, well, that's a true moneymaker.
Okay, folks. Peter, we appreciate your time. If you want to learn more about him, follow him on Twitter, or go to bookreport.com. That's BOOCK report.com. We'll have all the details on the show notes. That's goldnewsletter.com/podcast. Excellent, guys. Thanks so much.
Thank you guys for having me again. It was a lot of fun.
Thank you, Peter. It was great. We could have you on every week and still have lots to talk about. So really appreciate it.
Yeah, absolutely. Thanks so much.